Welcome as you tune in, as you log in. Welcome to our financial modeling crash course. This is really, I'm going to try to compress a lot of what I know about financial modeling into this quick 1 hour session. But there are, we've made a lot of extra materials and a lot of other stuff. So don't be afraid. You won't miss anything, and there's going to be a lot of follow-up materials to it. So. The other point I'll make is we always get this question, is this webinar being recorded? Yes, it's actually being live streamed on YouTube, like live streamed. So hi to the people on the live stream as well. You guys are like 1 minute behind on what I'm speaking, but hopefully you guys can participate as well. And if you have any questions or you want to be 1 minute up to date, just join us at the Zoom session. Okay, so it's enough small talking. We've got a lot to cover, and let's get to it. So, um, I actually hate the word financial model because it's not what you guys get asked most of the time. Like a lot of you guys maybe are here because an investor asked for a pro forma template. That's likely to happen, or you just want to kind of budget how much money you need to raise, or you want to calculate how much runway you have left. So all of those problems are answered with a financial model, but financial modeling as a word is just a bit overwhelming. And if you're not familiar with spreadsheets and so on, it just can be scary right off the bat. But I'm going to try to make it not scary. Okay, so what we're going to cover today. So the first thing I'll start is just the common problems with financial modeling, the stuff that we see time and time again with the pitch decks that we review and the sort of the startup prospects that we have to look at. So we'll start there. We'll jump into driver-based financial modeling, which again sounds like a mouthful, but it is really just kind of like a simplified version of it's sort of like an approach that we didn't invent, but that we developed to manage this stuff. And yeah, I'll get to it in a sec. But the cooler part of today is that we're actually going to model one of your companies. We're going to pick one of the companies in the Zoom webinar, and we're literally going to build your financial model. And you'll see that at first it can be done within a few minutes, 20 minutes or so, at least a simple financial model that can do some really good work on forecasting. And hopefully with that model that we build, we're going to have a chance to run some revenue projections and to run some scenarios. So in order to kind of get a sense of what this group looks like, I want to kind of understand what type of companies you guys are building, especially on the business model. So for now, let's just talk about the business model. And drop it in the chat. I've gotten better at multitasking now. So feel free to drop it in the chat. Let us know if you're one of these four company categories, which I think encompass most cases. One, SaaS, right? So subscription business. It doesn't even have to be a software, just a subscription business. So that's one. Marketplace would be another. Mobile apps, or just mobile apps, social media, any mobile app-based business model would be another, and then e-commerce. So if you're one of those four, drop it in the chat, and I'll kind of get a sense for what you guys are working on, and we'll try and model a company that kind of resembles something that a lot of guys are working on. So I see marketplace, I see SaaS, hardware, bunch of marketplaces today. So that's cool. Okay, we'll get back to this. Okay, so the only reason why we learned how to do this and why we know how to do this is because first I have to do financial modeling for my own company. I had to do financial modeling to raise the rounds of funding that we raised, but mostly because this is what our company does, what we help founders prepare for their fundraising, both from the pitch deck and from the financial modeling end. So what are the problems that we often see with this? One, and this is usually a telltale sign that somebody has not done their full homework on how much money they need to raise, is that the amount of money that they put in the pitch deck as, hey, we're raising $1 million, so we're raising $2 million, is this strangely round number? It's just $1 million. And I mean, I'm not saying that's a red flag in itself. I'm saying that's usually a telltale sign that somebody just didn't do their homework. I'm just going to put $1 million here and we'll figure it out. Like $1 million will be enough. We'll figure it out. But that means that they haven't really run enough math to say, I mean, ideally that number should be something like, I don't know, 875 or, 925 or, 550, something like that. Why? Because that means that you actually ran some math, you understand how much money you actually need. Maybe you inflated that a bit or you rounded it up to the next nice sounding number. But the point is, how much money you actually need. Usually when you do, or when you see, just 1 million, just plain blank, or 500,000, just, it's like, oh, have they actually run their math to understand how much money they need? Kind of another connection or another issue associated to that is when an investor goes to a founder, like they're pitching the company and they're like, okay, I'm raising, I don't know, 700. And then the founder will say, oh, sorry, the investor will ask, well, what if you can't get to 700? What if you only raise 500? Would that still work? And like the immediate answer, like the almost intuitive answer is, yeah, we'll figure it out. We'll figure it out at 500. Well, that may not be the right answer. If you're short on the money that you raise, you might just run out of money ahead of time. So don't do that. Next big problem, and probably the biggest one, the most common one, is that the growth projections just assume that the company's going to grow at some percentage rate month over month. And trust me, I've seen this in like advanced companies. I've seen companies with $2-3 million in revenue, and the way they're pitching their business to investors is, oh, we've grown 10%, I don't know, 20% year on year for the past few years. We're just going to keep growing 20% year on year. No justification, no backing, no financial forecasting of how they're going to achieve that growth, which is crazy to me. This will make sense in a sec. And then the other big problem is that I see companies focusing on the number of months that they're raising. So we raise money for 18 months of runway rather than reaching a milestone. I'm speaking from experience, and this happened to us, and it was shit. Like one of our shittiest company times was when we raised the seed round. We raised about $1 million as a seed round, and every startup information I had received, every advice I had received was, oh yeah, you should raise for about 18 months of runway. Good, that's what I did. We budgeted, estimated our runway at about 18 months with the $1 million that we had in the bank, right? And then 18 months later, I'm like, okay, or I guess 12, 14 months later, I'm like, okay, I'm running out of money now. I'm running out of money now, so let's go to investors and pitch our next round. And they're like, well, and which would be a Series A round, right? Because Series A comes after seed. And then most of the investors I talked to were like, well, you're not really a Series A company yet. You're still kind of like a seed. You've grown great. You have some good revenue and so on, but you're not a Series A company. Come back to us when you're a Series A company. I'm like, I have 4 months of runway. I'm not going to be a Series A company by the time, and I'm going to run out of money before I'm a Series A company. And they're like, well, that's tough luck on you. So that kind of, that's real. It happened to us. And the problem in our budget was that we should have raised more money. We should have budgeted how much we needed to get to that milestone, right? So in SaaS, a Series A round is normally $2 million, $2.5 million in annual run rate. We were at about 1 million in annual run rate. So we fell short, right? So we grew, but we fell short and we got stuck in that limbo, right? That happens as well with pre-seed to seed, right? So I see a lot of companies that raise a pre-seed round. It's an idea. They raise a pre-seed round to build a product. They build a product. They have just enough money to launch it, and then they launch it, and they're in this limbo of, okay, we launched the product, but it has no traction because we didn't have money to get traction. So we're stuck. We're stuck between pre-seed and seed because the seed round happens a little later when the company has some traction. So you don't want to be stuck in the middle, and that's why not focusing so much on the months of runway, but focusing on the amount of traction that you need to have. That's the key. We're going to get to this in a sec. But okay, the answer to all these problems is it's a spreadsheet, and we built a pretty nice, pretty solid, colorful, I want to say very intuitive spreadsheet that's free to download. That I'm going to give you a link in a sec, but we're not going to look at that spreadsheet for now. We're just going to focus first on the theory, on like the backing of it, and let's just make sure that we are on the same page. Now, making sure that you were paying attention. Okay, so how much money should you be raised for seed? Should you be raising for seed? I see 62 people, man. That's a lot of people in Zoom. Like, what do you think? Is it A, B, or C? Same for the YouTube guys. I see a lot of people on the YouTube stream as well. Maybe I spoke too much about this, but okay, I see a bunch of B's. I usually kind of hint at this a little bit and don't give you the answer right away. But yeah, absolutely B, not C. Not C. Why? Because when you're in pre-seed, when you're a seed stage company, you probably already launched a product, right? Most seed stage companies are at a stage where they've launched a product, they have some traction, they have some customers. Unless you're like a deep R&D milestone, deep R&D software or hardware type of company. If you're raising a seed round, you should have a product in the market already. But good. Glad you were paying attention. Okay. So we've agreed that we have to reach that milestone, right? So what we want to do is we want to budget, right? We want to make sure that we have enough money to get all the way to that milestone. And your chart of revenue against expenses would probably look something like this, right? So you have revenue green at the top and you have expenses blue and red at the bottom. I'm going to tell you what those means in a sec. And then probably at the early stages, you may have no revenue and just expenses, right? That's perfectly normal. You have to build a product, you have to build a team, and you have to launch, and your expenses are probably going to be higher than your revenue, right? But either way, you're going to have those two things. But the question here is, well, what's driving each one of these things? What's driving revenue? If you think the way revenue works, the way sales work in life, well, you have a sales team and they drive sales. Or if you're building an end user like an online platform, you do marketing, so you spend money in marketing, and then that generates revenue, right? So there's a cause and effect, there's a causality to these things, right? So the opposite approach of this is what I mentioned before, which is a company, and this is paraphrasing a real founder story. It's like, oh, we're just going to generate 700 orders the month that we launch, and then we're just going to grow that by 10% month over month. Great. If you want to put that on a spreadsheet, you don't need a webinar for that. You just do 700, 110%, drag the formula to the end, and that's it, right? And if you plot that into a chart and you put that on a pitch deck, it's going to look like a beautiful hockey stick chart. But what's the backing of that? Do you really understand what's driving that 10%? How much do you need to spend to drive that 10%? Normally you do, right? You have to spend money on your sales team. The bigger your sales team, the faster your growth in theory, or the more aggressive your marketing spend, the faster your growth in theory, right? So you have to kind of figure out those connections. What's driving what? So when I say orders in this case, your orders could be your traffic, your subscription, your monthly active users. In marketplaces, that could be your drivers and your writers. So either one of those. And then on the other end, what do these orders drive, right? They may drive fulfillment costs or hosting costs, support staff, maybe account managers. Maybe there's some account managing needed because you're dealing with large accounts. So what do the orders drive? And so again, we come to this sort of cause and effect situation in your forecasting where, well, revenue is at the core of it, okay, but the more revenue you generate, the more costs you're going to have. But that's probably the most obvious part that most of the companies that we talk to actually get right. So for example, if you were an e-commerce, you're selling t-shirts, that for every $100 that you make, every order that you get, you're going to have to go and print the t-shirt, and you're going to have to go and ship that thing, right? So it's almost, it's almost proportional that as you scale your revenue, and as you project that you're scaling your revenue, your costs are going to scale just the same, right? So costs, and this COGS means cost of goods sold, and that's the way you're going to see it in all your financial documents, cost of goods sold. Cost of goods sold is normally directly proportional to revenue. Yeah, you can get more efficient about it, but in theory, just the more revenue you make, the more costs you have. But again, to my point, what is driving that revenue, right? What's causing the revenue? It's not just 10% month over month. There must be something that drives revenue. So what are some good examples of revenue drivers? Well, first, an obvious example is paid marketing. And I normally don't, for a financial model, always think of a financial model as a spreadsheet that you use when you wear your CFO hat. So, as a CEO, as a founder, you probably have to be on top of everything, and you're probably going to have to track a bunch of metrics from what the company's doing. But, from a spreadsheet standpoint, you don't have to have everything in that spreadsheet, right? Your marketing team is going to be the people who track, your paid marketing campaign performance by campaign or by channel, right? You don't have to bring that into the model, but you do have to understand that, well, paid marketing is a driver of revenue, right? And there's an expense that you have to make to drive that revenue. So you could group all of these things into a single box. Search ads, display ads, retargeting, sponsorships, even influencer marketing, I would classify as a paid marketing campaign, right? Because you have to measure it and understand it. But another driver could be outbound sales, right? So that could be cold email, cold calling, business development, going to conferences, etc. Booths at conferences, all of that stuff. You could call that outbound sales or group it into that category. You also have organic traffic, right? So that could be, I normally like to group, everything that's organic, that's not directly controllable, like social media. We group our YouTube traffic into organic traffic. Word of mouth, SEO, referrals. I normally group referrals. A lot of companies kind of think really trying to make this complicated system of referrals, but unless there's a very deliberate aspect of the product driving referrals, I would just group that into organic traffic, right? I'd say that for us, Slidebean, we make, I don't know, 5 to 8% of revenue monthly comes from referrals, but it's such a small percent that we just think of it as organic traffic, right? And then returning customers, right? If you're a SaaS business, even if you're an e-commerce business, some of your business will come from reorders, right? People who are already your customers, who ordered in the past, who might come again. So these are what I've been saying. These are drivers, right? These are potential drivers of revenue, but not all these drivers are created equal. Some of these drivers have a direct money cost to you. They're a direct expense, right? So paid marketing is an expense. You literally have to spend money to make money. Same with outbound sales, right? You have to pay salaries, and that team is what's driving your revenue. Unlike organic traffic, right? The difference there is that you could say, well, I'm just going to double my social media team, or I'm going to double my SEO team. But if you double your SEO team, do you double your traffic? Not necessarily, right? That's not how SEO works or how social media works. You might just have a really efficient social media guy that's generating a lot of traffic and duplicating every month, right? So it's not directly proportional. Unlike outbound sales, your sales team, unlike paid marketing. But the point is that all of these, again, are potential drivers of revenue. And that's kind of like what I want you guys to understand. It's not just 10% month over month. We have to break that down. We have to go one level deeper to understand what's driving it and what's driving your revenue, and making sure that you're budgeting for that driver in your forecasts. That's the key of it. That's like if you want to steal a slide from me, it's that one. Like that's the slide that you want to screenshot. Sorry. I went too far back. I'm sorry. I'm gonna leave it for like 2 seconds. So this is the slide that you want to screenshot. Please don't forget, think of your drivers. Now, there's some color coding that I've been using. I'm going to explain it now because we're just about to jump into into building one of the models for you guys. And now that I've seen it, you kind of like your replies, I see service providers, SaaS B2B, subscription-based, SaaS and marketplace, SaaS and marketplace. I see SaaS. I mean, SaaS is probably the winner today. So we're probably going to go with SaaS. So while I finish explaining these last couple things, anyone who has a SaaS company, and we're going to build a simple model, so like a simple subscription business, drop me like a one, and if you want us to kind of build your model today and you want to share a little bit about your company, doesn't matter if you have revenue or not, just give me like a 1-line elevator pitch of what you guys do. Just drop that in the chat, and we'll pick one. We'll bring you up. Make sure that you have your mic set up and all of that, and we'll bring you up, and we'll literally like model your company. Okay. So while you guys do that, let me go quickly through the color coding that we use. Not inspired by Slidebean branding. But okay, so revenue is green because that's the color of money. That's the easiest. Like I said, cost of goods sold is everything that revenue drives, right? So the more revenue you have, the more costs you have, and that's red. Cost of goods sold, that's where you're going to see it in your financial model, in your P&L, and all your accounting and your books. SG&A, that's sales, general, and administrative and admin expenses. Some people call that OpEx, operational expenses. Some people just call that expenses, but it's the same thing, right? So anything that's directly driven by revenue goes in costs. Pretty much everything else goes in SG&A, except for, and just a quick understanding, capital expenditures. Those are classified a little differently in financial models. We normally don't have, tech startups or software startup companies normally don't have to worry too much about those, because that's like inventory. For example, from an accounting perspective, if your company goes and buys a car in, I don't know, Tesla, and you pay $40,000 for a Tesla, you don't get to write off the $40,000 as an expense, because you essentially purchased an asset, and that asset still has value. So that asset is not SG&A, it's capital expenditures. Again, exception. Laptops would probably count here, but laptops, depreciate so quickly that some people just put them in office expenses. But point being, those are the main categories and those are the main colors in the model. And I'm going to walk you through one. So I didn't see that many e-commerce, but this is an e-commerce financial model map. So this is what we call a financial model map. Think of the little kind of step-by-step cause and effect situation that I just showed you, but with a little bit of extra complexity. But I'm going to walk you through it so that you can get an idea of what I'm talking about, right? So, and what we're going to build now. So again, we have two main drivers here at the beginning of this flow chart. We have paid traffic and organic traffic, right? So paid traffic is blue because that's an expense. Organic traffic isn't blue. It's driven by your marketing team. There needs to be some logic behind that, but it's not a direct expense. And then paid marketing through a cost of acquisition that drives orders from new customers. Organic traffic with a conversion rate that also drives orders from new customers. And if we go from orders to this other side to orders, we see that big orders box on the right side. And then for every order, we have to deal with fulfillment costs, of course, right? Shipping and all that. And then for every order, of course, we make revenue. We have an average order size. And then we have an average product markup, which can help us determine what our product costs were and what they're going to be in the future. So that's pretty simple and straightforward. But we have that other bracket, that other branch down here where, well, we may assume that, for example, a small percentage of our customers, of our new customers, become regulars, right? Like they may come back every once a month and give us another order. So that gives us some repeat purchases, and that way we're kind of grouping those two, right? We're kind of grouping orders from new customers, orders from regular customers, and that gives us our total number of orders. So that is, I think, as simple as an e-commerce financial model map can get. But notice that we haven't touched the spreadsheet yet, and when we work with the companies that we work with on this, this is the part where we want to spend the most amount of time. Not only because we want to make sure that we understand the business correctly and then we can draw a map like this efficiently and accurately, but also, we want founders to get a visual of their business and make sure that all their business model and the revenue sources are accounted for. Okay, so let's actually build one now. Let's see. I have some stuff ready here, like a little template that I'm going to use. Again, these are all available for download. I'm going to give you the link to these in a few, but I don't want you guys to be distracted yet. Don't worry, you'll get a link. Okay, so let's see who do we have. Brian, we have, oh, guys, a lot of chat today. That's great. A lot of chatter. Okay, let's go to the beginning. Who typed faster? I see, there we go. Job management software for trades and construction workers. Digital platforms and seekers with expert religion and spiritual services. I'm trying to find something that's kind of general that I feel that that can be useful for a lot of you. B2B SaaS, therapy and engagement. Alexander, I'm interested in your case. You already have 3 million in AR. That's insane. That's great. I think that's. I mean, Alexander, if you're willing to share some of your, I mean, not deep numbers, not revenue numbers, but some of your conversion rate numbers, this could be really useful. Because we have references of what an actual historical. So if that's okay with you, Alexander, raise a hand, and we'll bring you up. There you go. We'll bring you up. We'll set the camera stuff, and then you'll be able to talk. Are you with us, Alexander?
Yes. Do you hear me?
There you go. Yep, I got you. All right, Alexander, why don't you tell us a little more about your company?
Sure. We are a company, B2B SaaS business model, IPTV services, and yeah, we are currently 3 million of ARR. And I mean, let's say, comparison with other SaaS business companies is that we have 20-ish customers who are on multi-year deals, which are so not let's say standard annual deals or monthly deals. So that's let's say maybe complexity for your modeling. And
Mhm.
also each of our customers basically have different terms, meaning some have different prices for same platform, or we
Yeah.
also
Okay.
have usage-based revenues
I got you. I got
with
you. I mean,
different
we can
tiers.
simplify some of that again for
Mhm.
today's purposes, and then we can so let's
Yeah,
simplify
sure,
it a little
sure,
bit. So it's let's
sure.
say that can we generalize it as an annual subscription?
Yeah, go
Okay.
ahead. Yeah, do your magic.
Okay. And next question is, so how do you sell to, this is B2B, so how do you sell to them? Is it marketing to lead? Is it an outbound sales team?
No, we get to the conferences where we basically find our leads and sell with them, or through referrals. So our main clients are big telco companies offering these, let's say, streaming services, basically.
Okay. Yeah, again, I'm gonna modify it a little bit just to kind of try and make it I don't want to say generic, but general, kind of like a more accessible so that other people can relate to the business. But yeah, we'll try and take it. What's the name of the company, just so I can write this down?
Yeah, Fiscalion.
Come again?
Fiscalion, like a million.
Fiscal. Can you type? You want to type that out? I don't want to get it wrong. Sorry. Oh, Fiscalian. Yeah, I almost got it right in my head. Okay, Fiscalian. All right. So, we have this little mirror board. This is mirror. I mean, it's free. The tool is free, but it's really, really good for flowcharts. So we just have some building blocks here that you can use. But in the end, we have customers, right? That's our core. They're on an annual plan. Uh, and then any subscription business, uh, you know, we'll have a renewal, right? Like a cycle of renewal. So in this case, they're annual, and that means that there's going to be a churn rate, right? So we get 100 customers, and there's even the best company will have some of those cancel. Companies go out of business and so on. So that's the first thing that we want to track. But in the end, the number of customers, right, is going to be our main. It's going to be one of our main KPIs, and that of course is going to drive our revenue, right? So again, Alex's case is a little bit more. So Alexander's case is a little bit more complex, but we're just going to do an annual subscription. And Alexander, if you were to give us kind of like an average annual plan for these customers, what do you think? How does that look like?
So basically, 100K plus.
Okay. These are 100K a year deals.
Yeah.
Okay. What I really want to focus on again, for this is the driver's part, right? That's what we're talking about. So, in this case, Alexander mentioned events, right? So normally the way I like to model events in these things is events, and well, that is a cost, right? It's a blue box. It's a cost. We'll say average events. I mean, we'll say events per year, or something like that. Events per year, or events per month. Do you do many a month, many a year, Alexander?
There's no cadence basically. So as soon as I got some info, there's an event, I'm booking my flight and going. So yeah, I don't know. Each month basically can be 2 to 3, or can be one by month. So
Okay.
basically, at
Yeah.
least one by month.
Yeah. We want to keep it an average, keep some average, right? And we
Yeah,
could
yeah,
do
sure, sure.
some average so we can forecast with it. So let's say events per month. These events drive leads to you, right? So that's the important part. The event has a cost. We have cost to attend, right? So cost per event, which again, we're going to work with an average cost per event. And then we're going to take that here and go to leads, right? So basically, Alex probably has this number, and I don't know if he's willing to say, but for every event that we do, I've seen, if you want to do a booth, it's probably going to be a $40,000-$50,000 investment. If you just attend an event, it's a little different. But point being is that for every event, we're gonna have a number of leads per event. I mean, we'll get to these numbers in a sec. Leads per event, those are leads, and then from all the leads that we get, we convert a few of them, right? So there's that conversion rate. Now, of course, another factor here is that for every lead that we get, we're probably gonna have a team member that processes those leads, right? And we're gonna call this an inbound sales team, where again, for every lead that we find at these events, we're gonna have to, somebody's gonna have to process that lead, kind of get them through the finish line and so on. So normally I like to do like leads per agent. So we could say, well, an agent can usually balance, 20, 30 leads a month. Our numbers are like 100 leads. So for every 100 leads that we get into the platform, we need about one agent, one extra agent handling those calls and handling those follow-ups. Again, this varies depending on the complexity of the sales process, but there's usually a proportion there that we want to account for. The idea here is that we don't want to forget that if we suddenly scale this and we have a bunch more leads, we're going to have to grow that inbound sales team as well. There are other, for a company like this one, there could be other sources, and that this is kind of like where I'm trying to kind of adapt this model to so that it works for more of you. You could have an outbound sales team, like a business development team, that's kind of reaching out to people and trying to find customers. You could say that team is also a driver of leads, or you could say that team is a driver of customers too, right? So like they're just converting, and you could say, well, for every agent, we get X conversions per month, right? So hopefully this is kind of like a visual representation of how a business looks like. We can make this. People sometimes go a little crazy with how complex they make these maps. I try to keep it as simple as possible, and also because we only have half an hour, I'm gonna keep it at here, right? But again, like events, you could name this marketing too, right? So, for another type of business, marketing is what drives leads, and you have a cost per lead, and then leads drive customers and so on. But it's the general idea is pretty similar. Now we're gonna stick with this for now. Again, it's a representation of what Alex does. So now let's bring this into a spreadsheet. Now we're gonna look at the spreadsheet. I always have this big monitor, so I always like to keep these side by side, because when I'm building stuff on the spreadsheet, I really just want to follow this, like this order of structure, and that makes it a lot easier to understand. It kind of keeps you keeps the model in the same page as the map. We actually have a page here where we encourage people to paste the map, so that whenever you're sharing the model with anybody, you can just you can share the map too, and people can go to that page and understand how things work. Right. So so quickest overview of the sheet. We have some tutorial videos about it, so I'm that stuff is recorded and decently documented. Just some basic structure of the sheet. Notice that we have pages pretty much corresponding to every kind of color code that we talked about before. We have a revenue sheet, we have a cost sheet, we have an SG&A sheet for all the expenses, payroll, marketing, and all that fits here. We have a capital expenditure sheet, which again we rarely touch, and then all of that gets consolidated into the monthly sheet, where again we have revenue, costs, that gives us our gross profit. We have SG&A, and net income and all that. This spreadsheet has some good functionality to estimate your taxes. If you live in a country where you have value-added tax, we also have some functionality for that. I'm not gonna get into it today. The point is that all this stuff is connected already, and then all of that is connected to an annual sheet as well, so you can look at that annual summary. So that's again basic overview, and then the other important note here is that we have this rule, and we didn't invent this, but in accounting, where any input in the model we try to keep as blue, and we actually format that with a different color, different font, and then any formula result is black. And the reason why we do that is so that it's a lot easier in a model to just go and say, especially for you guys that are kind of hopefully grabbing this template, which again is free, just to add it, just to know where you can add stuff, right? We could say, oh, we're going to pay for this email tool, and we're just going to add that $100 expense. So we know that everything here is blue as a placeholder. I can add Slidebean as a thing and just pay $29 a month for that. And then, that I input that here, but I know that gets connected to the total, and the total gets connected to the total SG&A, and the total gets connected to the monthly statement. So all of that is connected already. In other words, when you change blue numbers, know that everything's going to be consolidated where it needs to go on the spreadsheet. So you don't need to, you don't need to start from scratch. People will charge you hundreds of dollars, sometimes thousands of dollars for just doing that. But it's free. Okay, but let's actually put this to work, right? Like we can use this sheet for the very basic stuff. For example, we have a staff sheet here, and we can say like, yeah, I'm gonna hire myself as CEO. I'm gonna start, I'm gonna raise, say, let's assume that I'm gonna close a round of funding in March, and that's when I'm gonna start paying myself. So my salary will be, it depends on when you live. Let's say that it's gonna be 80. And then again, that takes care of doing that, right? It takes care of adding that role and adding that salary and so on. Okay, but let's actually jump into these assumptions, right? So we're probably going to be working here on the revenue sheet because this is the number that we're trying to find, right? How much revenue is this company making? But we need to understand a few things first, the events part and so on. So that's why we built an assumption sheet. So the assumption sheet is kind of like a good place to keep all of the assumptions in the same place and just easier work on this. So let's bring that in. I'm literally going to translate the map that we built into some assumptions, and then we're going to go through the process of connecting them. Okay, so we said that we're going to have a number of events per year, right? So we'd say events per month, we said. So we're going to have a number of events per month. Again, I'm going to steal the format here. It's just a number, and we'll say it's an average of 2. Okay, great. And then from that here, we have events per month. We have a cost per event. And Alex, do you want to, so Alexander, do you want to give us a reference of how much an event costs to you?
You can put any number you want.
All right, let's say I'm going to use my own reference. Doing a booth
sure.
at it, may cost, I don't know, 25,000. That's the cost of everything, right? Travel, expenses, and so on. Okay. And we're going to say leads per event. So how many leads per event? Oh, sorry, let's call this category. Let's title leads per event. I don't know, 50. Does that make sense, Alexander?
Yeah, okay. Yeah.
Okay. Leads per event. And then we're going to have leads per agent. Sorry, leads an agent can handle. Leads an agent can handle, which is going to be, well, I'm going to use my own reference. It's about 100 leads. And then customers, right? So then we have conversion. So it's conversion rate from lead to subscription. And that's a percentage, and let's say 10%. Right? So I mean, when we built these for our customers, we normally just work with placeholders because everything is, these can vary a lot. Now, what I think is really useful of breaking it down and sort of forcing yourself to think about each one of these steps is that when you do that, leads per event is not a secret number. Like I can, we've done a couple of videos with companies that do events, and they've told us like a booth normally drives 300 leads, 350 leads. We have a video with Charmogul that we did with them on SaaStr, kind of like revealing how that works. So yeah, you can find that in podcasts and articles and so on. So like these aren't secret numbers. No, companies are normally willing to share part of that. So you can always kind of bring those numbers and sort of do a benchmark against run a benchmark and say, hey, like our estimation is not crazy because, here's some actual real data from companies that, that generate that much revenue, or sorry, that generate that type of KPI. Okay, let's get these connected and see how those look. So we're probably going to connect these in the revenue sheet. And we're going to have events per month here. So events. This is a really easy one, right? Because we said that, we said that there are going to be 2 events per month. I'm going to add one extra line, assuming that, many of you guys are pre-revenue. So you haven't started it. And it's a good exercise. So let's assume that Alex's company hasn't started doing this yet, and we can add a launch date. It's a little extra formula magic that we can do. Okay, so here what I want to do is, well, let's say that this is going to launch in March. So in revenue, I'm just going to go to March. This is a good way to test it. And we'll say like, well, if the month that we're currently in is larger than or equal to the launch month, right? We're going to be running 2 events. And if it's not, then it's going to be 0, right? So I've just referenced those sheets, that sheet, and I've kind of connected one to the other. I want to lock these values, right? Because we're always going to reference the same rows. I'm going to make this bigger in case you can't see. Yep. So you do that with dollar signs in Excel, pretty basic spreadsheets. We have a video with more detail about it, but I'm going to assume that you know. Right. So if we drag this formula along, we can test it and we can see that, okay, like it's going 0 before March, and then after March goes to 2. And then if we change that to August, then that changes to August. Okay. Now we have events cost. Right. That's also a pretty simple line where we'll take the number of events that we did, right? And we're gonna multiply those by the average cost. Now, the important thing here is that we've just connected that to a little section on the sheet, this key indicator section. But in order for us to account for that, we have to connect it to the SG&A sheet. That's easy. We can just go to the SG&A sheet, find a row. We can maybe do marketing and growth, probably. We'll call this section events, and we'll just bring the value here from revenue. Right, so now the model accounts for the cost of those events. Since this row is a formula, I want to change that to black, and that way I know that the number is coming from somewhere else. But now the model is accounting for your annual cost of events, depending on how many events you run. And again, if you want to change the number of events, or you want to do on average of 2.5, that's fair, right? 2.5 per month, that could be fair. Okay, next step. So we have leads per event. We now want to go to, I'm sorry, we have cost, we have leads generated. So leads, this is a numbers value. And then for every event, again, we're going to generate about 50 leads. Good. Okay, so that's 125 leads that we're generating because we have an average of 2.5 events, which is valid. We're forecasting for the future, so we could do decimals. That's okay. Now we're going to do agents needed to handle those leads, right? So agents needed handle leads. That's a simple division because we're just going to take the number of leads that we have, right, and divide it by the number of leads an agent can handle, right? So that's going to give us, in this case, 1.25, but normally we can't hire 0.25 of a person. We have to round that. So normally I want to, when we're dealing with that, I want to round that number up. And that way we just get a number of agents that's always an integer. Again, dragging those. We probably don't need decimals for that. Or for leads, or for event. I mean, we don't need decimals for any of these. Okay, so now we have the number of agents. We still have to connect this, but don't worry. And then the last step here is conversions, right? So we've done this, leads per event to leads per agent to this. Now we have a conversion rate to customers. So new customers. It's a numbers value, and we're going to take the number of leads times our conversion rate to subscription. We also want to round these, right? Because these are normally with small checks, small deals, you can keep decimals. But in this case, since Alex's revenue per customer is in the 100K, you don't want decimals on that. So let's round that up. And that's that. So now we have new customers per month. Now, the magic of this is that the last thing I'll do is I'm going to connect this agents to leads, right? So we know that events cost and agents to leads. These are expenses and they're SG&A. So I normally kind of format those as blue so that I remember that they have to be connected there. But let's connect the agents to leads. I'm going to go to staff. I'm going to select one of our staff lines. Let's call this the inbound sales team. And again, normally this sheet will allow you to, to kind of scale that, define, just like we did before, define when you hire that role and define their salaries and how many people you have. But we're going to ignore this, right? Because now we have a number that the model is giving us about how many people we need. So I'm just going to delete this. I'm going to mark it as, mark it something as, let's say, managed from assumptions. And then I'm going to SG&A, and I have a payroll here. Sorry, not a payroll, a headcount. And this line that we added, the inbound sales team, again, notice that it's erroring out because we deleted the formula. But I can just bring the number that I estimated in revenue, right, on the agents that I need. Just drag that along. And now what the model is doing on an annual basis, it's telling me, okay, this is the marketing and growth expense, so your events expense, and this is the payroll expense that you'll need to do to handle those leads. Essentially, what we're estimating is, well, this is how much driving all this revenue is going to cost us. And we can go more aggressive with this, right? We can say, well, the number of leads per agent, I'm sorry, the number of leads per event could go higher. But maybe our team is going to be more expensive as we scale, right? So we're going to estimate a higher salary for them. Or maybe we're going to go more aggressive and we're going to do 4 events per month, right? And what does that do to our numbers, right? And we know, like we've essentially calculated all of that. The last step in the puzzle is just estimating the revenue, right? So I'm gonna, just for simplicity's sake, and I want to make sure that I have some time to answer your questions. I'm just gonna do the first year subscription revenue because I've run out of time. Sorry. For every customer here in assumptions, we'll say that we'll make 100K, right? So we'll say revenue per customer. That's going to be 100K. Right? And we're going to say new customer conversions. This is going to be a dollar value. And we're going to take the number of new customers times revenue. Just drag that along. Really, really nice and solid numbers looking, $2.8 million right off the bat. I'm gonna connect this to this green line, which is kind of like the consolidated revenue line, which connects it to here and connects it to everywhere. There we go. So now we have, how much in theory can this squad drive, right, at these conversion rates. And then the idea here, like the magic of this, is you can start evaluating how your business looks like. Well, what if your conversion rate drops to 5? Right? And what does that do for your business? Also take into account that we're not accounting for renewals just now. We're just accounting for new revenue. But, at least in the basic version of Alexander's business that we built, it looks like a very profitable business. If you want to connect costs as well, I saw the question there in the chat. That would be a box here, right? Where you say, well, what's the cost of serving each one of these customers? Which is important, right? Costs, let's simplify that. And we could say, well, costs of serving a customer monthly could be hosting costs. I don't know. We can add that too. We can say that, it's, I don't know, a couple grand per customer, something like that. And again, because we have those KPIs, we have those values already here, we can say, cost servers. Yeah, servers. We'll just say, okay, we'll take from revenue, we know the number of customers that we converted. We don't have the cumulative, right? Because they renew and they stack up. But for now, we'll just take the new customers, multiply that by the cost, drag that formula, make the row black so we don't forget that it's a formula, and then that gets connected. So that's how you do a financial model. The core, like if you want to take any lessons from today from this exercise, is that first, this is just simple math, right? Notice that I didn't do, there's one if, but otherwise it's just basic multiplications and divisions. It's just understanding where things go, and especially understanding how this map works out. Like mapping your business makes it so much easier to just bring it and put it in a spreadsheet and get it to work. So that's my those are my takes for today. So let me give you a couple of extra notes and then we'll get to questions. Sorry, screen is too many windows, kind of crazy. Okay. Yeah, so we've gone through the spreadsheet. Again, the spreadsheet is a free download. I think my team pasted it in the chat already, so please go ahead and download it, use it, break it. There's a good knowledge base connected to it. How we can help, how our company can help with this. 2 main ways. We built a whole financial model in 30 minutes. I know it was a bit rushy, but next week we have a boot camp where we go through the process of building one I'm teaching you guys to build one, and it's 5 hours of pre-recorded content, kind of like an extended version of what we just did, and then 5 hours of live sessions as we go through troubleshooting and kind of teaching you guys how to build formulas, Q&A, and I host those sessions myself. We do one a day. It's kind of like an intensive 1-week boot camp. So if you're interested in joining that, we'll paste the link in the chat, and hope to see you guys around. that's news one. Also, if you want our team to, if you don't want to do it yourself, and maybe your business is very complex, or you're not familiar with spreadsheets, our team, we have a service where our team not only builds the model for you, we build a map, we build a model, we build the custom formulas, but we also keep the model up to date against your actuals. So if you need to, we sync up your P&L and we bring your actual revenue and we kind of try and map it to make sure that things work out. That is all I have. I'll stop sharing my screen and I'll get to your questions. If you want to drop them in the Q&A thingy on Zoom, maybe that's a little bit more structured. But also, if you want to drop them in the chat, that's okay. Okay, where's my Q&A thing? Sorry. And I have my YouTube live stream here on the other side. So if any questions come there, I'll answer them. Okay, so I see Gareth. Need to talk to you guys directly. Not sure how this can work for a service-based business. Just shoot us an email. Webinars@slidebean.com. That's the team that runs our webinars, so they'll know the context of the question. Link for the spreadsheet. Yeah, so the one I worked on. I'd rather not share the one I worked on. I'll share it. Doesn't matter. Let me just get a link. You guys can see a little bit of the formulas I built. Hopefully, steal some of them. Anyone's link can view. There you go. Yeah, so that's the spreadsheet I just built for Alexander. If you want to take a look at it. No questions today, really. One of our largest cohorts, but no questions. I have 8 minutes left. Oh, there you go. We got it. So Matthew asking, do you have a bootcamp scheduled after next week? So we normally do one a month. We actually do this in part for our customers and people who are subscribed to our Slidebean platform. So that's why we do them one a month. But we also have people who are not on our pitch deck services happy to participate. So we have one in next week, and then I believe the last one of the year will be on the second week of November. I think it's November 12th. I don't believe that we're going to do a December webinar, but we'll see. On December bootcamp, sorry. But yeah, we have others. Dates will be announced after we kind of close the loop on this one. Where do you put one-time R&D costs in the model? Normally, I like to keep those in SG&A, Andrea. Some companies have tried to kind of shift that and put R&D costs in capital expenditures, but that's really more an accounting question, like a tax question for your local regulations and guidelines on how to classify it. But normally it's a salary, right? An R&D cost. It's a team that you're paying, so it's usually an SG&A. Yuna, or I'm going to use Hannah. I don't want to mispronounce your name. Hannah, would non-salaried remote sales closers who are paid commission be on COGS or SG&A? To me, they would still be in SG&A. Like I like to think of SG&A as sales, general, and admin expenses. So sales is in there, which means that marketing is in there. So normally I would put it there. Costs to me, and then the other factor is that costs, the balance, like revenue against costs gives you an answer to a question, which is how profitable is your business in theory, right? At its core, revenue against the cost of offering the service, how profitable is that? So I like to keep that gross profit number more pure. And when you start adding salespeople there, that kind of starts making the number jump up and down depending on how efficient the sales team was. So that's why I really believe sales teams should go on SG&A. Next one. So for marketplaces, there's a cost to get the demand and a cost to get the supply. They each lead into sales in a way or another. Any ideas or suggestions? Yes, I do have an idea or suggestion. Let me show you real quick. Sorry, let me share my screen again. Yeah, so we've built a few financial model templates. I forgot to say that that are kind of pre-built. I think there's 79 on our website. So they're all built on top of the same free spreadsheet that we shared with you. But we've built a few for kind of like common business models. And we have one for marketplaces, which I know is a little bit complicated. I mean, the map looks somewhat complex. But I don't want to go over it completely. But then the idea is that you have these two sides of the equation. I'm going to use kind of like let's use maybe this Uber example, right? Where you have one side of the market, which is the drivers, and you have acquisition for the drivers, marketing, organic traffic. That's how you get new drivers to sign up, and that's active drivers. right? And there's a set of costs to bring in driver. And then on the other side, that's the supply side, but then the demand side, you have customer acquisition. So that's the ads going to people, right? So that's paid marketing, organic traffic, again, going to writers. This is writers, sorry, it's active writers. Ah, writers there. And then that's the demand side, right? That generates rides, and then there's revenue associated from it. So yeah, it's like a two-side thing where you have to market or do sales or do organic or produce organic traffic that generates people on either side of the equation. Those can connect very differently, but the marketplace model that we have, sorry, is decently flexible and kind of accounting for many of the different scenarios that you could do. Cool. Zainab, how do you build a model map? I mean, in our spreadsheets or in our financial model template on the model map page, there's a link to a free Miro template that you can use. You have to sign up for Miro, but it's free. And that's where you can kind of build a flow chart and get started from it. So yeah. Any chance you or your team offers a webinar workshop on how to best scale the business? We don't, Chris. I'm sorry. I guess that it's hard to kind of scale. I mean, it's very, it's case by case, right? It's very different to scale a SaaS business B2B versus a B2C. So it's hard to kind of put that on a webinar. So we don't have one. Hopefully we'll have time to kind of come up with a session that works. Sorry. How do you prevent hockey stick exponential revenue curves that are not realistic? Right now, the only way I've limited is by limiting the number of customers each staff member can handle. Are there any other scaling problems specifically for electronics companies that should include in the model? I mean, hockey stick charts are not inherently bad, right? They're bad when they're just a percentage growth, right? But if you're doing, if you're doing kind of like the logic behind it, where if you're thinking, oh, here's a sales team, and that sales team is driving these number of team members, and I'm accounting for the salary for that sales team and how much they're going to cost, and I'm putting a realistic value of how much revenue they can drive. And I'm also being realistic about how quickly I can scale that team. Then if your output chart is still a hockey stick, then that's great because that's a hockey stick that you can defend, right? What you don't want is a hockey stick that's just magic. That's just 10% magic, 10% growth magic. But if you've done the math, a hockey stick is not inherently bad. On the contrary. Would you use the assumptions to cater to more advanced forecasting techniques like Monte Carlo simulations or even fundamental? Yeah, I mean, I've seen, in more advanced models, I've seen like the practice of kind of like putting assumptions in the same sheet as revenue. I don't love that. So keeping assumptions separately is one good base. But I think that every model needs like a dashboard, right? Every model needs a dashboard where you input, what you're going to assume. Probably the most advanced stuff that our model does is discounted cash flow simulations. So discounted cash flow estimations. I don't love those. Companies sometimes request them to kind of understand what their valuations look like. But unless your business already has revenue, so if you're just trying to estimate a valuation from assumptions that are not backed up by your data, then this kind of cash flow is just it's just poof, it's just air, right? It's just ideas. But yeah, like I think assumptions apply pretty much to every model. Just to answer your question. Mark on the YouTube stream, hey, do you think this financial model would work for a startup in India? I don't see why not. Regulations are different, but we've adapted it a little bit. So you have VAT, depending, I don't know if India has value-added tax, but you have different income tax rates and so on. So yeah. And maybe last question for the day. I see a couple more. Yeah, so the few, so F Saint 10, I don't know, email. How to use a spreadsheet to probably show that there's a strong potential in the business. I mean, I think that having assumptions that come from reality is the best. If you don't have reality, if you don't have historicals, then you have to make up numbers. That's just what it is, right? If you have real values that you're bringing in, like this is our historical number, then your model is going to be really accurate. If you're just making up numbers, even if I mean, it's not going to be as accurate, obviously, if you can kind of find a range of those numbers that's backed up by reality, by the performance of other companies, then that starts to get better. But obviously, the ideal is you are bringing your own historical numbers into the model. I mean, if you're pre-seed, you still have to estimate. If you're pre-seed, I think the model is the most useful for budgeting, right? You want to make sure that the money that you raise is enough right? So it's not that much about revenue. It's about making sure that the money that you raise is enough to get to the next fundable milestone, which is not launching your product. Again, it's seed stage, and seed stage requires a little bit of revenue. Is it necessary to use TBV? I don't know what TBV means, Cyrus. I'm sorry. How do you estimate your own salary for a seed round? Just reasonable salary. Under market salary for what you do, definitely, but just a reasonable number that makes you not worry about. I saw a financial model yesterday of a company that of a CEO that was trying to pay themselves $500,000 at pre-seed. I thought that was crazy. I told them, but yeah, just reasonable salaries. You're not getting. I mean, you don't want to get rich on salary. You want to get rich on equity, right? Equity is what pays us founders, not salary. Salary is just enough to get by. Should be just enough to get by. How do you leverage a financial model that don't have any revenue? I think we talked about a little bit about that. Any financial model for education services? I mean, education probably is a subscription, maybe. So maybe you can use the SaaS model. And then the last one, I'll say, Chris, can the spreadsheet take into consideration varied amount of revenue per customer? Would it be based to simply take an average? Yeah, normally at the early stage, you want to go with an average. You don't want to kind of model separate customers. I mean, you can eventually, but even us, like we do this for a living, even we use averages, right? Because it's very hard to, unless the difference between one type of customer and the other is too different, you can probably go with an average and get 95% accurate with that. So you don't need to kind of go break it down. So I've gone 2 minutes over. I know you guys have things to do. So hope that this session was useful. If you want a longer version of it, I hope to see some of you guys in our full-on bootcamp next week, intensive bootcamp. We also have another webinar coming up next week on pitch decks and how to kind of write a pitch deck and how to develop a pitch deck for investors. So if this one was good and you enjoyed it, check that out as well. Catch you on the next one.
Thank you everyone for assisting to attending this webinar. We'll be hosting a pitch deck webinar next week. Please visit our events page on our main page for Slidebean